iron condors just don't work. I don't like iron condors. I can't make any money with iron condors. They're just not profitable for me. These are some of the things that I hear when people talk about iron condors. So in this video, I'm going to share with you kind of 4 main reasons why most traders fail when it comes to iron condors, and some of the things and issues with them, and what you can do to kind of fix those problems or things to watch out for. So we're going to go in deep here. If you're brand new, I'm Sasha, the options coach. I've been teaching people to trade options for many years, probably about a decade now. And we just did an iron condor deep dive here along with some other classes. And that's where this video kind of stems from. It gave me the concept of, well, let me shoot a video on this topic. And you'll probably see this, a month or two later down the road after we already filmed this class. But one of the things we talked about was really just some of the issues when it comes to iron condors, and kind of try to tackle some of these different things. And there's a lot of types of iron condors, from equidistant, equal delta, high probability, low probability, unbalanced, gamma iron condors, or reverse iron condors, really, as they're known. And, there's a lot of issues that people have. They can't get iron condors to work, or they're unsuccessful. So here, we're going to tackle a few of those issues. So one of the first bigger problems that I see is position sizing. So if you go in and you do an iron condor, like, this is what people do, is they structure an iron condor, and when they go in and do this thing, let's say, bam, I'm doing my iron condor behemoth. And when you position size, they go in, they go 20 contracts here, baby, 20 contracts here. So we've got put side, we got call side. So they go large, and that position size is almost too big for their account size or what they feel comfortable with. They think they feel comfortable because they got range, right? You've got this big range, but the issue is that if it starts to test you and starts moving against you one way or the other, you've got a problem. Now, not only is it about contract size, it's also about the width. So sometimes I see people doing a 30 wide or 50 wide because that's what they see on the internet. So instead, sometimes it's just too wide, and you should be going maybe then a 5 wide or a 2 wide, and that makes it much more peaceful. Instead of doing 20 contracts 5 wide, you could go 10 contracts maybe, or 8 contracts like 2 wide. So a whole big difference there in terms of capital positioning and the risk that you have on hand. Okay, so that's kind of the first thing. The second issue and thing is concentration of risk. Okay. The other thing is that, just in a similar way, this is a little bit of a tangent to what I just mentioned. We've got 20 contracts here, we've got 20 contracts there, and we're doing it here on the same vehicle. Let's say this is SPX. Well, it's all in one spot. Maybe it's a different ticker. Maybe it is Apple. Okay. Whatever the case is, we've got concentration of risk in this one spot. It may be in the same duration. Let's say it's a August expiration or a December expiration. It is all in one spot. Okay. Instead, what we could do is we could do one ticker is Apple. Let's say we spread our risk. We do, instead of, one stock with 20 contracts, we could do one contract on Apple of this iron condor. We could do another iron condor on, let's say, Meta. Okay, or Facebook here. And we could do another iron condor maybe on, let's say, Netflix or something else. So now you've got spread your risk, spread your money in different zones, different areas. And you could do this one in, let's say, October. This one is a later October, so it's, let's just say, October plus 7 or 10 days. And then this one might be in November. So you've got kind of different expirations, or you put them on different days. Now you've spread your risk and your capital. So that makes it a lot better in terms of that concentration of risk. You've got things spread out in different zones. Okay, third thing we're going to take a look at is short duration. Okay, there's nothing wrong with doing short duration, but if you combine kind of position sizing that we talked about and you're doing short duration, a lot of people, they've seen this picture when it comes to theta bases. So meaning like days till expiration. So you've got 0 days, and then you've got, let's say over here, like 30 days. So this thing decays, and you've got the value of the option. And this is what people try to hit, is they try to do that 0 days so they could compound those things faster. The problem is that they haven't seen the reverse part of this curve, where when you have a time decay, you've also got a price risk that you're accelerating. So yes, we have this time decay benefit, but the issue that we have is the price risk that goes with it. So that is a bit of a problem. So watch out for that. And shorter duration, I'm not saying there's anything bad with that, but what happens is you're really accelerating the risk that goes with it, especially if you're new and if you're doing iron condor, and if you're doing it with size and you're concentrating your risk. That's where things really start accelerating with like high octane, and can blow you up or get you into some trouble. All right, last thing. It's going to be number 4, and that is management. Management's kind of the last part right here, beyond, of course, psychology, which is also important, and many other factors. But management, when we want to look at management, what people do is, they manage it a certain way, but they haven't really tested things out with management. So let's say it starts moving against you one way. Well, one way to manage could be to move the leg out if you have time and if you're not in a short duration and you try to make it back. Another way is just to get out of the iron condor when it hits a certain loss point. Okay, and then just reset a new iron condor. Now, this is where the position sizing kind of comes into play. So for example, let's say you lost $200 over here. Well, now you could go in and you could say, okay, well, I'm going to risk $400 to try to make back part of the loss I had earlier. Or you could say, well, I'm only going to risk $100 to kind of chip away at the $200 loss. You can size it a little bit differently if you like, or you could size it the same way. I'm going to just put on the same exact one, because the point that you're trying to do is say, okay, I've got these iron condors, and let's say you're making, let's just call it $100 here, $100 here. You're making $80. Maybe you're making $30 on some. But what we don't want to do is, okay, as we're losing some, we're losing 80, then we're losing another 60. Okay, but then you're making back maybe another 80. What we don't want to see is, eventually, as you do enough occurrences, we don't want to see a $600 loss, because what it's doing is giving up a lot of these wins and gains. So management of that position is critical, because when you hit those nasty losses or those bigger moves against you, that's where the problem can lie. So anyways, those are the 4 things I would watch out for if you're doing iron condors, and some of the pitfalls and issues I've seen over the years when it comes to iron condors. We just kind of covered a lot of this stuff in the iron condors deep dive class. But I hope that helps, gives you a little insight and take on it, because there are definitely things to watch out for. So thanks for joining me. Truly appreciate it. I will see you on the next one. Take care.